Yes, in the previous video, we went over the fair value gap theory, Ario's fair value gap theory. How we can understand the breakaway gaps and the actual fair value gaps. So through that video, we got a great understanding and we now understand which fair value gaps we don't want to trade back into on the short term and the long term, and which fair value gaps we do want to trade back into. Now, how can we improve that accuracy? And how can we now understand which fair value gaps actually do want to hold, where we can look to make some money, where we can capitalize on those moves? Because that is, of course, our goal. Theory is nice. How can we put it into practice? We are going to incorporate two new concepts. Where the first concept is the lack of creation of a new fair value gap, which you've already probably seen on my channel as well. And the second one is time. With the first concept, again, being that lack of creation of that new fair value gap, that concept is quite simple. So right now on the weekly time frame on YM, we are seeing that we have this weekly fair value gap in the making, not a breakaway gap. Just purely based on this price action alone, we can already understand right there that we might actually want to trade back into this fair value gap to then continue higher, purely based on that breakaway gap understanding. But how can we actually see that coming? How can we know that we actually want to create that fair value gap, that we don't want to create a breakaway gap? Well, if we go into the daily time frame, then what are we seeing? On the daily time frame, and if we now reverse engineer this price action, then at this moment in time, at that candle, here we see the expansion phase on that Tuesday. That expansion phase should do what? Should, by the understanding of that 3 candle pattern, should create a potential fair value gap, a new daily fair value gap higher, which means we should stay above this first candle high right there. If we stay back above that, then anywhere with the third candle, whatever it wants to do, that will create a fair value gap right there at the third candle once that third candle closes. All right, then right there, what do we see? Boom. That does not get created. That new daily fair value gap higher does not get created, showing us the lack of that bullish intention, showing us the lack of a new fair value gap being created. But again, do we wait for that lack of creation of a new fair value gap on a daily time frame? No, because we talked about capitalizing on it, which means we are now going to use the lower time frames as well. And if we go into the 4 hour, and again, we reverse engineer it a little bit more, this right there is that level that we need to stay above. We need to stay above this level right there in order to maintain that bullish intention on the daily. So at this moment in time, we see this 4 hour fair value gap. Perfect. 4 hour fair value gap right there can continue higher off of that, create context targeting those highs. After we reach those highs, what do we see again? Well, we have the same expansion phase that we saw on the daily. 1, 2, that third candle should stay above this first candle's high to create a 4 hour fair value gap higher, which we see the same thing happen. We do not create that new fair value gap higher. Well, thank you, Captain Obvious. We obviously have bearish price action right there in our replay tool. No worries, we are going to show you how to actually do this, how to go over it, how you can see it coming. Because right now we understand, all right, we did not create that 4 hour fair value gap higher, so we can continue lower, of course. After that huge candle lower, yes, of course, thank you, we can see it. But at that moment in time, we first off have, of course, that sting into those levels. Now, so what goes actually before that? Let's reverse engineer a little bit more. Then on the 1 hour time frame, what are we seeing? This is now also where the understanding of the fair value comes in, which we also mentioned in the previous video. And again, that breakaway gap understanding. What are we seeing in this leg higher? So I'm aiming at this leg higher right there. What are we seeing right there? We have this fair value gap. Based on the breakaway gap, we already understand that third candle closed above this high. So we now understand this is likely a breakaway gap. Then the next thing we also understand is that we have this fair value gap as well, which the same thing happened. Right there, we also closed above this high right there, meaning that that is likely also a breakaway gap. So if we go back 1 candle right there, then that is the breakaway gap understanding. which already means that we potentially have 2 breakaway gaps. Then the next understanding we had as well on the fair value understanding is the 3 swings. What was the 3 swings again? We have buy side, we have sell side, and we have buy side again, which offers fair value. Again, understanding that the market does one of 2 things. It's either seeking liquidity or it's offering fair value to then continue higher or continue lower. If we are not offering fair value, we are seeking liquidity. If we are not seeking liquidity, we are offering fair value. Fair value in the form of we need buyers and sellers in the market. So once we had this move higher, we had buyers in the market. Once we had the move lower, we had sellers in the market. So both buy side and sell side formed right there. Then once we were allowed to move higher by price action, because price action right there is allowed to move higher, because we already offered fair value. If we are allowed to move higher, that means that the price action we are seeing right here is now fair value, because we are moving higher. We are allowed to move higher again, which means that if that is fair value, then the only place that is not fair value at that moment in time is the area above those highs. Because here we only have buy side in the market. So if we were to retrace, then the area here should now be respected. So we shouldn't expect a big retracement. We should immediately want to continue higher. Then we also have 2 potential breakaway gaps right there. So the fair value and the breakaway gaps. Why do we have this big down candle right there? That's quite suspicious, right? If this is truly a breakaway gap. All right, let's dissect it a little bit more again. Then if we go into the 15-minute, then what do we see again? On the 15-minute, we have this 15-minute fair value gap sitting right there. That 15-minute fair value gap does not create a new fair value gap higher, which as a general rule of thumb, once we come into any fair value gap on any time frame, the first or the second candle will have a wick right there. We'll have a wick showing that it's respecting the fair value gap. If the first candle actually closes inside the fair value gap, then if we come into that fair value gap late during this candle's phase, usually we can see it close inside the fair value gap, then sweep the candle low right there before we actually continue higher. So that is the first or the 2 candle. You know now which candle you want to look for that expansion. Where if we come into that fair value gap during the first candle, we can already look to continue higher off of that. We have the respect. We should now create a new expansion phase of a fair value gap, which we are simply not doing right there. Indicating to us, that is quite suspicious again. Next step is we now have a new bearish fair value gap right there. And that bearish fair value gap can now be responsible to target this 1 hour fair value gap sitting right there potentially, which was originally a breakaway gap. So do we expect that 1 hour fair value gap to potentially hold? Well, we expect the fair value area to hold. But we didn't have a reason to come back to this fair value gap right there because it was a breakaway gap. So after that, we see that we then have a new 15-minute fair value gap lower, and eventually we look to hold. Right there, we understand that the last area price could have continued higher from was the fair value area, which on the 1 hour we discussed was this area right there. The breakaway gap, we should not have traded back into that, which was already suspicious. So the only area to hold was the fair value area, which we get an aggressive move lower into the fair value area. We have no reason to offer fair value again because we've already offered fair value. So this breakaway gap that we're seeing right there is not relevant. It's nothing to worry about. And then that fair value gap is also where we had this line. Remember this line? This line is now, what is that? That is the line where the 4-hour fair value gap is now preventing from being created. So we have the lack of creation of that new 4-hour fair value gap, which we are seeing on the 15-minute right there already. Which after we have this, then what are we doing? Well, we are not offering fair value on the 1 hour. So what are we doing? We are seeking liquidity in the form of this. After we seek this liquidity in the form of that low, what are we doing right there? Well, we are also coming into this line again, What is that line again? That line is the daily fair value gap being prevented again from being created. So we have that lack of creation of the new fair value gap as well, which means what is the lower fair value gap that we can target? This fair value gap sitting right there, which means that overall, what have we done? We are preparing to trade into the weekly fair value gap sitting right there. And which candle on the weekly time frame have we traded? 1, 2, 3. It's the third candle of the fair value gap being created, which is known as it can potentially trade back into what? It can trade back into the weekly value gap that is about to create. Price is already taking into account fair value gaps it's going to create. For price to be efficient, if you were the market maker and you had to offer fair value and you had to trade back into a fair value gap, don't you think you would also like it to be a little bit easier to trade back into the fair value gap to then already continue higher? So what would you do? You would set up the next candle already to trade back into the fair value gap, an easier path to trade back into the fair value gap because it's closer to then continue higher off of that, right? That would be the most efficient solution. And this is how throughout that week, we already trade towards a weekly fair value gap that hasn't even been created yet. And we can tell it's becoming a fair value gap and not a breakaway gap by those concepts. But what do we also see? Well, on the daily time frame, we see one single day right there that actually pushed lower, that actually had that big rejection right there. And that is where the majority of the price action actually happened. Well, why is that? That is where time now comes in. So in my opinion, I have a beautiful analogy and I want to share it with you. Where if we want to go from one point of the country to the other side of the country, then we need a car, right? To get across the country. We need a car. And that car can be as beautiful as ever. A car can be super nice. But if that car doesn't have fuel, doesn't have gasoline, nowadays also electricity, then that car simply won't move. So the idea to go to the other side of the country is nice and all, but we simply don't have the fuel to support the idea. So what do we need? We need fuel to use the car. What do I mean by that analogy in price action? The car is price. Time is fuel. In other words, gasoline. You can have the best looking price action in the world, but if time is not agreeing with the idea, then it won't play out. Again, when I say won't play out, it's low probability of playing out. The market is all about probabilities right there. It's not a binary thing. Very important to understand that. And when time is agreeing, we have high probability of something actually playing out when we see it in price action. So all the IDs I went over before we touched on this analogy were price IDs. And price IDs are nice and all, but price IDs happen everywhere. There's only one differentiator to when one price ID plays out, where one other price ID doesn't play out. And 9 out of 10 times, that is time. When we have time agreeing, price is allowed to play out. And again, the way I want you to view that is time is the volatility, because time leads to volatility in the market. It's nothing special again, it's volatility in the market. And volatility, as we understand it, is again seen by how much are we actually moving in the market. So if we have a lot of volatility in the market, we are moving a lot higher, a lot lower, which if we have a trend, what is the basis of a trend? That we are moving higher or lower. So in order for us to actually move somewhere, we need to have volatility. And the volatility is time. We have two types of volatility. The first one, which you mainly want to be referring to on the daily at the 4 hour, is referred to the economic calendar. The economic calendar will tell you when price wants to actually move lower and wants to move higher. Because on all these days right there, Wednesday was the most volatile day. Why? It had the volatility. If you look at forexfactory.com, which you'll see right now on the screen, it had red news. The economic calendar was supporting the idea of trading that day. And then you have the second type of time, which is kill zones, which for your indices, YM, ES, NASDAQ, is equities open. And the only thing I want you to use right there is from 9:30 until 4 p.m. 9:30 a.m. until 4 p.m. For your Forex, the only thing I want you to pay attention to is 2 a.m. to 10 a.m. And I'll show you why you don't need to dissect that and why you don't need to get into those small time windows, etc. So all this was fun and games right there on the daily, preventing that daily fair value gap to be created. 4 hour fair value gap not being created as well right there. And then on the 1 hour, the fair value gap story. On the 15 minute, the fair value gap lower right there. Now, why did this 15 minute fair value gap hold right there? Why was price allowed to push lower right there? Well, first of all, we also need to understand then that every fair value gap that is being created in a kill zone has a high probability chance of actually holding. With holding, what I mean by that, a fair value gap that holds is a fair value gap that creates a new fair value gap. For example, this fair value gap sitting right there, that fair value gap holds wide, creates a new fair value gap higher. So in kill zones and fair value gaps that are being created in kill zones, like these right there, have a high probability of holding, which means that this fair value gap right there has a high probability of holding. Then after we come into it and we don't continue higher off of that, and we create a new fair value gap lower off of that, then which fair value gap has now the highest probability of holding? Because they're both created in kill zones. So time is now supporting the idea of both those fair value gaps. Well, only one fair value gap right there is not creating a new fair value gap, which is at that moment in time, this one right there. So where time was both agreeing right now, price was the differentiator right there. The concepts we went over, the lack of creation of that new fair value gap and the time. So this fair value gap is now the fair value gap we can look to trade off of, which on the 1 minute, you can go into that time frame, and on the 1 minute, you simply look for a 1 minute fair value gap lower right there, and you have that 1 minute fair value gap lower covering the highs sitting right there, targeting lower 1 to 2, whatever your current target is. Well, what actually is our current target? Well, on the 1 hour, what did we see? On the 1 hour, we had this 1 hour fair value gap, which again, we don't really expect higher prices off of. But can we get a rejection? Yes, of course. So we need to take that into account, right? So once we take that 15-minute short, or sorry, that 1 minute short right there of that 15-minute fair value gap, then once we reach this 1 hour fair value gap, we just need to take into account we can get a rejection. So what do? You go break even. So in the worst case scenario, you have a break even right there and you're simply wrong on the whole ID. Perfectly fine, we accept that. We're also going to be wrong sometimes. With this theory again, and the whole theory and everything that I'm teaching, I don't want you to get the impression that these things is 100% win rate. It's not. In 2023, I've had an 80% win rate, which when people see 80% win rate, they automatically always think, he only wins because he has such a high win rate. You forget the times that I also lose. I also have a 20% losing rate. So I also lose. Yes, I do lose. But the winners way outperform the losers. And that is the important thing. So again, all these things work great if you put in the work. That's also very important to understand. It's not I teach you a sentence and go off and have a 100% win rate and become a millionaire. No, it requires work. Very simply said. And after that, once we are already break even, we see this fair value gap right there on that 15-minute time frame as well. So this trade eventually ends up being a winner, but let's now look at this right there. Because that 15-minute fair value gap, we have the 1 hour fair value gap and the 15-minute fair value gap. Which one is now the one that wants to hold? Remember how we went over that weekly fair value gap and how we can know, all right, what does the weekly candle, the third weekly candle actually want to do? Well, how can we know what this candle wants to do? So I'm aiming at that candle. How can we know what that candle wants to do? By also doing the same, by going into the lower time frame inside that candle. So inside that candle on the 1 minute time frame, we see what? 1 minute fair value gap is going higher right there. Right there, 1 minute fair value gap is going higher. Eventually, this 1 minute fair value gap creates a new 1 minute fair value gap right there. But overall, we can see this was originally a breakaway gap. This fair value gap does not create a new fair value gap, gets disrespected by a new bearish fair value gap sitting right there. Afterwards, we create another bearish fair value gap sitting right there. Then this bearish fair value gap is now what? Well, that is simply an entry. Covering the highs, targeting what? Well, this is where it now gets interesting. Because on the 1 hour, we had this next target in the form of that 1 hour fair value gap. But that is where fair value was already offered. And that is also where the 1 hour fair value gap was a breakaway gap. So we can look, we're not offering fair value, target liquidity. Liquidity is simply swing lows, swing highs. Swing low, next target. After that, we are doing what? Well, we are now coming into this line right there, which was what? Which was the daily right there. The daily failing to create that new fair value gap higher. So after that, what is the next target? The daily fair value gap sitting right there. And eventually, the weekly fair value gap that is in the making. Can you see how the dominoes are starting to fall right there? Where eventually, the target, of course, could have been crazy. Now, this is where I need to be very clear. This is not a realistic trade at all that I would advocate on this is something you can catch every day, even every week, even every month. This is a very rare opportunity right there. And what I would always advise and what I teach, a little mentorship insight, is always look to simply target a 1 to 2. And if you are looking to target these lows, all those lows right there, then if you reach a 1 to 2, take 80% off the table. So an 80% partial, and let 20% run to wherever you want it to run. Go break even and just let it go. So again, it's not my intention to show you that trade and say, you can hold to 10 RR and this happens every day. No, we need to have realistic expectations about our trading here. Very important. I'm just showing you that once that first line of defense right there on the 1 hour falls, then all the dominoes falls after that. It's a domino effect. First one falls, boom, that one falls, that one falls, that one falls. And with that logic of not creating that new fair value gap, with that logic of time, because why did we trade that day? Because that day had the economic calendar new supporting ID, and the fair value gaps right there that we are trading off of are created in what? In kill zones. So we understand which fair value gaps should hold, and if they don't, and they lack that new creation of that fair value gap, then why do they not hold? Because likely we want to do the opposite thing. And then really quick, touching on Nasdaq again, we had this weekly fair value gap, which we talked about in a previous video, of course. See how this now applies to the weekly fair value gaps that we talked about in the previous video as well. If we go into the 4 hour time frame, then on the 4 hour time frame, we saw this 4 hour fair value gap. Why did we have us staying into that exact fair value gap? Time. And when we talk about that car again, where news is that fuel, is that gasoline, in news you have a big 3 news events. The big 3 news events is NFP, CPI, and FOMC, all for the US dollar. That is where ideally the day before and the day itself, you want to get involved after the news release. So not during, not before, after the news release. After the news release, it will simply tell you right there in which fair value gap it wants to sting into with that NFP release. After that, we also see this sting into that 4 hour fair value gap right there, which was what? That was CPI, which also came into the fair value area. So that car analogy that we used for that news is that gasoline, big 3 news events is the turbo, it's the nitro, it's that nitro button that you press and all of a sudden from your exhaust there's flames coming out. Almost Back to the Future type of things. Where we already know, according to price, there was something destined to happen. News is a curtain. It's that smoke screen. It's an alibi of what is already destined to happen to now do it faster. Does that mean you should trade on the exact news release? Again, no, don't do that. Because it only requires you one time to be wrong during CPI, NFP, and FOMC, and you can say bye to your profits. That's not what we want to do. We want to be professionals. So we wait after that. But after that, we sting into those 4-hour fair gaps, which just leads to our 5-minute entries, which we talked about in the previous video as well. And then in the move higher overall, what do we also see? Well, on the 1-hour time frame, we see, for example, this fair value gap getting respected right there. That fair value gap is getting respected because it's, again, a 1-hour fair gap being created in a kill zone, where people talk about lunchtime in the indices kill zones. And the same goes for Forex, where in between 5 a.m. and 7 a.m. is known as that lunchtime in Forex for your kill zones. In between, generally speaking, 11 a.m. and 1 p.m. or 1:30 p.m. on indices, that is also lunchtime for the kill zones. So lunchtime meaning that we expect a consolidation and we don't really expect any much price action, etc. Well, I want you to think about this again, where we use the logical explanation on if we want to continue higher, we already want to prepare price to trade into potential fair value gaps. Well, if we want to take lunch and we are in the middle of finishing a task, do you think we want to take lunch? Or from my experience, when I'm busy recording a video, for example, I'm not in the middle of the video right now going to eat, going to drink something and then come back. No. Likely when I then come back, I don't even want to record the video anymore. I don't even feel like it anymore. I want to finish that task and then reward myself after with some nice lunch. Well, currently it's midnight for me, so not much lunch for me. But I'm going to reward myself with some nice sleep. Where right there, we come into that 1-hour fair value gap already. And on the 1 minute, then eventually, we continue higher off that 1-hour fair value gap already. 1-hour fair value gap sitting right there. 1 minute fair value gap higher right there. 1 minute fair value gap higher right there. Choose a fair value gap that you want to get involved on. Choose your entry pattern. The entry pattern is the easiest part of trading. And here, during so-called lunchtime, we eventually move higher. We reach the target in the form of these highs right there. And eventually the high we had to the left as well. And then you see we have the real lunchtime right there. Again, this is time plus fair value gap theory. This requires case studies on your side. So please feel free to make those case studies. Feel free to even share them with me. Nice and all that theory, but if you want to see the money making team do this over and over and over in real time and seeing how we call those moves, seeing how we capitalize on those moves, then the money making team and the mentorship is the place for you. And again, if you have any questions regarding the mentorship, regarding the money making team, send an email to info@ario.io and we can go over it. All right, perfect. Thank you.